Hey everybody, Silverbusters here, and today I just wanted to do a little charting with you on the silver price here, and the focus is really going to be on a comment that David Morgan has made multiple times, and that is that in a bull market, you get a metals bull market, you get 90% of the move in 10% of the time. And so what I wanted to do here is test that on the previous data and see, extrapolating from that, where would that put us in the current cycle, and what kind of high would we expect if we see a similar pattern to the previous one. So to follow that pattern, basically we're going to use this if we're looking at a chart here of silver from the 2010 to 2012 period, when we had the spike high up to 47. I believe it may have traded around 49 or 50, but that was a closing price, I believe. And so if we see a move here from 17 to 47, essentially, so we're going to say that's $30 of a move there in the span of time. It says April 25th, 2011, and then down here, August 16th, 2010. So between August and April, so August, September, November, December, January, February, March, April, that's 8 months, okay? So if we saw a $30 move in 8 months, that means we should have seen a roughly only a $3 move in a period of 27. Well, we got to do it here. That's 8 months, so 80 months. So let's go back here and test this out. So if we go back 80 months, we might have to pull out the calculator here. So if we go back, 80 months is 80 divided by 12. Let's do that math real quick. 80 divided by 12. And how many years is that? Well, that is 6 2/3 years. So if we are here at August of 2010, then we have to go back to basically 2004, which ironically, I mean, that's kind of like the first little spike up here that you see. And the price move here, though, is a little bit, I don't think it conforms to the 90% move here. It might be closer to 80-20 here, which honestly might be more realistic, because 80-20 is something that you see in other patterns in the world in general. 80-20 is a big deal. But so if we go with 5 to 16, 5 to 18. So 5 to 18 is a $13 move, right? So we got a $13 move in a period of 6 years, 6 and change. And then we got a $30 move in just those 8 months that we were looking at earlier. So, I mean, I would have to pause the video here and do the math, and I think I'll do that at the end. But you can, I don't think it's exactly the 90-10. I think when I crunch the numbers, it's going to be closer to 80-20. But you can see the pattern here that we're talking about how long of a building phase, and then a bull trap, and then returning to this median, and then a spike up. How long that all that had to be built into the system there to get it started. Now, so if we go back to this, and we're going to use, the $14, $15 support level as our new jagged line over here, that our $4 to $5 jagged line, baseline, and then we've got the spike low, the COVID spike low for 12, and then the instant recovery here. So where are we now, right? Is this equivalent to this? You know, is that where we're at? That this low here, and we're entering this kind of phase right here, the lead up to the big spike, because if you're following this pattern, you've got baseline, right? And then over here, you've got baseline, more or less. You've got noise. You've got noise over here between $4 and $6 and $7. And then over here, you've got noise between $14 and $16, maybe $18 up in there a little bit, the spike low, and then pop. You got this first kind of little, doesn't this look a little bit similar to you, this pattern? And then the drop down. So if this drop down is as much as we were getting over here, and then we've recovered up to the highs and maybe even started up over here, you know, when we made that run to 35, there's really not that, I know we're closer to 30 right now, but there were a couple of days in there, you know, it said 34. We were trading in close to 35 intraday, and we've come back down closer to 31.50 right now. So what I'm going to do is pause the video here. We're going to crunch some numbers, and we're going to get that added onto the final slide here, and we're going to see how close this period of time conformed to the 90-10 or 80-20 theory, and then if this period of time here is the new one, what are we looking at? Because maybe we don't have enough time in here from the 2014 kind of spike down lows here, if we use that as our starting point. But if we do, what kind of top number do we get by performing this analysis? So I'm going to pause it and crunch some numbers, and then let's see where we're at after that. Okay, so I ran the numbers, and I went back and did the previous silver run from the price lows in the 2003 period, late 2003, and the run up to 2011 spike high up to 47. And while we didn't see the 90-10 pattern emerge, we did see a very lopsided pattern where you had a very long period of slow growth, the 81-month period down there at the bottom, where you saw about 30% of the total movement in the price to the spike high, and then a very short period in the 9-month time frame where the price spiked, had almost 70% of the total move. And that's where you get these, hockey stick shaped patterns at the very end, where you get a long base and then a big spike up. And so the question now is, what if we saw a similar run up compared to what we've been enduring since the lows on the opposite side of the spike? You know, because I pulled one of the lowest prices I could find, and I made it in December just to keep things simple for the rest of the math, so I could deal with the years instead of individual months. But I found the price in 2015 of $13.94, and I think the lowest was $13.90 in January. But let's go with that number. And if you had come in at that price level, well, today you've seen in 108 months, 9 years, from December 2015 to December 2024, you've seen a price move of $17.61 down there at the bottom over 108 months. So what if that is our 30%, and the upcoming 12 months or 1 year would represent the 10th year, so the 10% time frame, right? So if we get a 70% move in a 10% time frame, your final price in December of 2025 for silver would be $72.64, with a move up of $41.09. Okay, I just want to add in here, there's no guarantee of this happening. We could still trade down to sideways in this kind of choppy range and just keep pulling this base out. So this is just a theoretical if we are hitting this spot now. And then the thing that I noticed is there's a huge difference between these numbers if we plug in the 80% or the 90% time frame here. You can see how much it picks up if the move that we've seen thus far is only 20% of the move or only 10% of the move. You can see if it's a 20%, we got 101 as the final price. And if it's 10%, we get 190 as the price. So when people ask me what my exit points are, it's numbers like this. These are the points that you should look at for exit numbers, because if we follow a pattern and we're going to get some sort of exponential pattern as typical, you need to be looking bare minimum in this sort of range for any of it to make any. So these numbers really got me interested and makes me want to go back to the 1980 high and look at that run up and see if that's the actual bull market, the actual run up that David Morgan was talking about that experienced the 90-10. Because if you're going to make a distinction between the bull market that we experienced in the 2010 timeframe and the one that we experienced in the 1980 timeframe, all the numbers that I've seen from the 1980 timeframe suggest that where the gold price went, and I realize this is silver, but where the gold price went took gold to the price that if the United States government wanted to extinguish all of its debt by basically backing all of its dollars with gold, it was something, or at least their debt, that they could do it. I've seen these charts built out where the amount of credit that the U.S. was getting based on its gold reserves was almost nothing at the 1980 high. So basically the market took all the faith out of the loaning capability of the U.S. market, and we didn't get anywhere close to that. First off, it's debatable whether the gold is still there in Fort Knox and in the Federal Reserve. And then the second question is it encumbered? Has it been leased out? Has it been promised to multiple people? Are they double counting it? And those are all good questions. But when we got to the 2010 high, even at those price levels, at $50 silver and whatever gold was at that time, there was nowhere near the amount that gold would need to go to in order to extinguish the national debt, right? So it looks like if I had to draw a distinction between the two rallies, one was cut short, I would argue, through artificial means, right? We have all these paper trading accounts, and it was engineered up and engineered down. That it was taken down effectively with influence on the paper market. And the one in 1980 wasn't. It went to its natural endpoint. And at that period of time, Volcker was in the Federal Reserve and could take interest rates to 20%. And the federal debt was at a much lower level, and the federal government could tolerate that interest rate. Now we're nowhere near that. And that's what makes me think, I'm speculating on a couple different levels here, that we're far more likely to get a number that's on the 90% side here than on the 70% side this time. So very interesting when you take a look at it in that sort of perspective. But that's all I've got for now. I thought this was an interesting mental exercise to do with the silver price. If you guys have any good links for accurate charts for the 1980 run-up, the 70s and 80s time period, let me know, because I'd like to confirm that suspicion of mine and go back and look at the 1980 rally and see how that all ended up, and if that's where the whole 90-10 bull rally math got its start. Anyway, this is Silverbuster signing off for now.